Welcome back, traders and creators. In today's video, we're going to talk about the best, and I mean the absolute best Forex strategy that you can implement today. But before we get into that, make sure that you subscribe to the YouTube channel and follow us on Instagram so that way you can make sure you stay up to date with these amazing videos and the daily Forex content. All right, back to the video. So today, I'm going to talk about the absolute best way to trade in the Forex markets. There's a lot of different strategies, indicators, and methods that people use in order to become successful day traders. But in today's video, I'm going to talk about the absolute best one that can give you the highest risk to reward ratios and also just help you understand how these markets are actually working. Not just theory, but actually what's going on behind the scenes. So let's jump right into it. So basically, the way that we trade, I call is smart money concept. When you're in the markets, you have to realize that you're not the only trader. And I'm not talking about all the other millions of retail traders. You need to understand that you are playing with big fish, with the big whales. And I'm talking about the big banks, the hedge funds, the JP Morgans, Citibanks, Deutsche Bank, all those billion-dollar players. Those people are the people who are moving and manipulating these markets. They are the ones who control where the markets move in vital areas. And I'm going to show you a great example of that today. So let's just say we're a retail trader, right? And anytime retail traders see lows being formed, right, we could see this as a double bottom, or we can see this as an exhaustion of the market. But for whatever reason, the market decides to stop in this area. And so that catches the attention of a lot of retail traders. And so what happens in this area? You start to see a lot of buying power because the market's coming down, stops, and then you see buyers take over. Well, eventually what happens is you start to come back down to this area, market exhausts. It looks like we're going up, right? At one point, this was an all bullish candle. You've got a lot of buying power, and out of nowhere, you have this massive bearish engulfing candle taking out all of those buyers, hitting their stop losses, right? If you're buying here, your stop loss is probably here, being taken out by this candle. That takes out a lot of buyers in the market, and then the market starts to uptrend again. Well, what a lot of people do is, since they got stopped out over here, or maybe they missed this move, they decide that there is a lot of buying power in this area because we stopped and completely reversed the markets. Markets stall a little bit, we get more buyers back over here. And so now we have another accumulation of money over in this area. We have even more buyers. And then eventually what happens once again is the market starts to come down, come down, come down. And let me zoom in on these candles. What happens is right here in the 15-minute time frame, we have a massive bullet or bearish engulfing sweeping the lows of these stop losses, any stop losses in this area, and the stop losses right here. And basically what happens is money is collected from all the buyer stop losses, and then the market reverses from this area. But the nice thing is there's a thing called mitigation. These big banks have to sell in order to buy. So when this market is moving up, they have sell positions still in this area from hitting everyone's stop losses. So they need to take the orders and the money from the retail traders, and then they take opposite positions in order to get themselves in profit. But at this point, they're hedging their bets because they have sell positions here and buy positions. So what they need to do is move the market back down to where they originally sold in order to get themselves out of those sells, break even, and then continue to buy the markets up and up and up. And the way that you can understand this method or how you can take advantage of these trades is basically realize that there is money and liquidity sitting in these areas. There is money and liquidity sitting in these areas. And when you realize where retail stop losses are, you realize where big money comes into play. And when big money leaves clues like that, you need to realize that you have to take that manipulation candle, bring it out, and now that is going to be our entry area, this gray zone. And eventually what happens is market comes up, looks like it's going to go away forever, and then it dips all the way back down. And what a coincidence it is that it dips down into this candle, this manipulation, this FU candle. It dips down back into here. This is where you could have taken your entry. Take your long position, your stop loss right below that low, only 11 pips. And then you can take the reverse of this method, right? We see highs right here. We see highs right here. And so now we have two take profit areas. With our stop loss being only 11 pips, we can then take our take profits to 60, which is a 5.5 risk to reward ratio. Or we can even go higher, and we can go to 6.8. Imagine having trades that are 11 pip stop losses and over 75 pips in take profit. And then you can continue to keep going and have over almost a 10-to-1 risk to reward ratio. Now I know this is a short video, but if you guys enjoyed this method of trading or thought it was helpful, make sure to follow the YouTube and the Instagram channel for more content like this, and that way you guys can become successful, profitable, and self-sufficient traders. And hopefully you guys can realize what's really going on behind these markets. I'll see you guys in the next video.